Bitcoin just dropped under 65,000, nearly 200 million liquidated in minutes, and yet at the exact same time, Wall Street is accelerating deeper into crypto. New ETFs, banks entering the space, corporations stacking Bitcoin. So the real question is this panic or positioning? Let's break it down. Welcome back to the channel, your daily breakdown of what's actually happening in crypto without the noise, where we connect the dots across markets, institutions, and on-chain trends. So you're not just seeing the headlines, you're understanding what's really driving them. Quick reminder, nothing in this video is financial advice. This is for informational and educational purposes only. And if you find value in these breakdowns, make sure to like the video and subscribe. It helps more than you think and keeps these daily updates coming. Let's start with what everyone is reacting to. Bitcoin dropping below 65,000. And more importantly, 190 million in liquidations in just 15 minutes. Now this isn't just price action. This is market structure at work. What you're seeing here is a classic cascade. Leverage builds up, positions get overcrowded, and once price starts moving down, liquidations trigger more liquidations. It becomes a chain reaction. And in crypto, because leverage is so accessible, these moves happen fast. But here's what matters. This kind of flush doesn't necessarily mean weakness. In many cases, it's actually necessary. It resets the market, it clears out over-leveraged positions, and it creates space for more sustainable moves. So while it feels like panic, it often functions as reset and rebalancing. And this becomes even more important when you zoom out. Because while retail traders are getting liquidated, institutions are doing something very different. Institutions are not backing off. While the market is pulling back, we're seeing continued signals that large players are still moving in. Let's start with a major shift in narrative. A senior ETF analyst, Eric Balchunas, compares Bitcoin today to Facebook when your parents joined. At first glance, that sounds bearish, like Bitcoin has lost its cool factor. But if you really think about it, that's actually a sign of mainstream adoption. Facebook didn't die when it became mainstream, it scaled. The same idea applies here. Bitcoin may not feel early anymore because it's moving into its next phase. And that's being reinforced by what we're seeing from institutions. Take Morgan Stanley, proposing a 0.14% fee for spot Bitcoin ETF. That would make it one of the cheapest in the market. Now ask yourself, why compete on fees? Because they expect mass adoption. Lower fees equal more accessibility. More accessibility equals more inflows. This is how traditional finance expands markets. And it doesn't stop there. We're also seeing Square enabling Bitcoin payments for millions of sellers. This is huge because it shifts Bitcoin from just a store of value to something that can actually function inside the real economy. Payments are one of the most important pillars of adoption. And when a company like Square integrates Bitcoin at scale, it's not experimentation, it's implementation. Now let's talk about something even more important, corporate accumulation. We've got reports that American Bitcoin has reached 7,000 Bitcoin in reserves. That puts them among the top publicly tracked holders. And this is part of a larger trend. Companies aren't just exploring Bitcoin anymore. They're holding it on their balance sheets. Why does that matter? Because it changes the role of Bitcoin entirely. It's no longer just a speculative asset. It becomes a strategic reserve. And when companies start thinking this way, they're not reacting to short-term price moves. They're positioning for the long term. And then we have something even more interesting. Strive filing for a digital credit ETF. But this isn't just another crypto ETF. It targets debt instruments tied to companies like MicroStrategy or Strategy, which are already deeply connected to Bitcoin exposure. So what does this mean? We're starting to see second layer financial products. Not just Bitcoin ETFs, but instruments built on top of companies tied to Bitcoin. That's a sign of maturing market structure. Now, let's zoom out and connect everything. On one side, you have volatility, liquidations, fear-driven price action, and on the other, you have ETFs launching, banks competing, companies accumulating, payment systems integrating Bitcoin. This is the split that defines markets during transition phases. The narrative feels uncertain because the market is shifting from speculation to infrastructure, and that transition is never clean. It's volatile, it's confusing, and it often shakes out participants who are focused only on price. But if you follow the capital flows and the institutional behavior, a different picture starts to form. One where short-term fear exists alongside long-term expansion. And historically, that's where some of the biggest opportunities emerge. So here's where things stand. Short-term volatility is shaking the market, but long-term infrastructure is being built in real time. Institutions are moving, corporations are accumulating, and adoption is expanding. The question isn't whether crypto is evolving, it's how fast. If you found value in this breakdown, make sure to like the video and subscribe. And I'll see you on the next one.